They said it was impossible. They said silver stacking was just a hobby, coin guys and basement preppers clinging to old money. They said the paper market would keep the lid on forever. They said $75 was the ceiling. And the banks would defend that line with everything they had. But today, the market delivered a verdict that won't be forgotten. The wall is gone. Look at your screen. Silver is trading at $75.60. We didn't just tap resistance. We smashed through it. We closed the week at the absolute highs. For the last 3 years, $75 has been the line in the sand, the level where every rally went to die. Where commercials piled on short exposure to crush sentiment and reset the narrative. But today, their algorithm failed. Today, the sellers were overrun by a wave of buying that simply would not stop. In this emergency market update, we're going to break down exactly what just happened. We're going to explain why breaking $75 triggers a mathematical event known as a gamma squeeze. We're going to look at the weekend nightmare facing short sellers who are now trapped underwater. And we're going to prepare you for what comes next, because the breakout is confirmed. The ceiling has become the floor, and the chase is on. To understand the magnitude of this move, you have to look at the calendar. It's Friday, December 26th. Most of the world is on holiday. London and New York are running on a skeleton crew. Volume is thin. Usually, banks use this ghost week to paint the charts red and demoralize investors into the new year. But today, the opposite happened. Instead of a smash, we got a melt up because the physical bid didn't go on vacation. Industrial buyers in Asia, disciplined capital, and the quiet silver stackers who've been accumulating for years all saw thin liquidity not as a risk, but as an opportunity. With senior risk managers away, the door was unguarded. So they kicked it down. They'll try to tell you this is just another spike. They'll say, it ran too far, too fast. And they'll point at the chart like it's a magic trick that has to reverse. But a break above $80 isn't a normal move. It's a regime shift. It's the moment the entire story flips. From silver is capped to silver is in price discovery. And those are two completely different markets. For weeks, the consensus was loud and confident. Silver can't hold above the key levels. Every rally fades. Smart money sells into strength. The ceiling is real. The banks will defend it. That skepticism wasn't random. It was the setup. It trained people to hesitate. It trained traders to short breakouts. It trained investors to wait for the pullback that always came, until the day it didn't. And then it happened anyway. Not slowly, not politely. It happened fast, with follow-through, right in front of everyone's eyes. That's the real headline here. The point isn't simply that price went up. The point is that a widely believed, never level failed in real time. When a market breaks a level that everyone treats like a law of physics, it doesn't just change the chart, it changes behavior. Look at what happens next. Shorts don't just lose money, they lose certainty. They stop thinking about profit and start thinking about survival. Sidelined buyers don't feel patient anymore, they feel exposed. They feel the pressure of being left behind. And that pressure turns into chasing. Market makers don't sit around debating headlines, they start adjusting risk, hedging exposure, and responding to flows at a speed most people don't understand. The tempo changes, volatility changes, the entire rhythm of the tape changes. That's why you can't treat this like a random pop. In a normal market, resistance is a ceiling. In a regime shift, resistance becomes a doorway. Once silver proves it can live above $80, it invites a new class of participation, funds that require confirmation. Traders who only buy strength. Algorithms that flip from sell the rip to buy the break. And when that crowd arrives, the moves don't come in neat little steps. They come in surges, gaps, shallow pullbacks, and sudden accelerations that punish anyone trying to trade it like last month's range. This is rare, and it's expensive to misread. Missing the meaning of the move is worse than missing a few dollars of upside. Because if you understand what just changed, you stop asking, is it too late? And you start asking, what does a new range look like? You stop watching the chart like a spectator and start watching it like a participant. Where do we hold? Where do we retest? Where does the market accept price? Because in price discovery, the old rules don't disappear, but they do speed up. So let them talk. Let them say it's impossible. Let them call it a blow-off. The breakout above $80 isn't a rumor or a theory. It's proof. What they said didn't matter. What the tape just did matters now. And once you accept that this is a regime shift, the next question is the one that separates spectators from survivors. What is actually powering the move? Because if you think this rally is happening only because more buyers showed up, you're going to misread the speed, underestimate the violence, and get shaken out the first time the chart starts moving like it's possessed. This rally is different because the engine isn't just hype. The engine is options mechanics, positioning, dealer hedging, and a reflexive feedback loop that can force price higher even when the headlines look the same as yesterday. Here's the trap most people fall into. They look for a simple story. They want one villain, one hero, one catalyst, a speech, a CPI print, a breaking news alert. But modern markets don't always move on narrative. Sometimes they move on plumbing. Sometimes the price explodes because a very specific set of strikes gets threatened. And once that happens, the market stops being discretionary and starts being mechanical. Look at the options chain like a map of pressure. When silver grinds toward major strike prices, levels where there are huge clusters of call options, market makers are not just watching. They're exposed. They've sold contracts, collected premium, and they're betting the price stays below those lines. As long as silver sits under the strikes, they're comfortable. But the moment silver crosses into that zone, their exposure changes fast. And when exposure changes, they have one job: hedge. That's where the rally stops being emotional and starts being mathematical. Market makers hedge dynamically. As price rises, they buy futures or underlying exposure to neutralize risk. That hedging creates real buying pressure. That buying pressure pushes price higher. Higher price increases the need to hedge even more. And that's the feedback loop, the self-reinforcing cycle that turns a normal breakout into a runaway move. It's not retail FOMO did this. Retail might be cheering, but the heavy lifting can be done by forced hedging, by algorithms following risk rules, by institutions that can't decide to stop just because the chart looks extended. This is why the candles get violent. This is why you see acceleration right after a threshold breaks. This is why the market can feel like it's teleporting. Once ignition happens, the next steps become increasingly automatic. And that's the point the critics miss when they call it irrational. They're analyzing the move like it's 1995. Like price only responds to fundamentals and sentiment. But today, price also responds to positioning and forced flow. The plumbing matters. The hedging matters. The options chain matters. So if you want to survive and profit in this environment, you have to upgrade the way you think. Stop staring at headlines, trying to predict the next tweet or the next talking head. Start watching the flows. Start asking better questions. Where are the big strikes? Where is the dealer pain? Where does hedging flip from passive to urgent? Because when those lines get crossed, the market doesn't move like a debate. It moves like a chain reaction. And once you understand that, you won't be shocked by the speed. You'll be prepared for it. You'll expect it. Because in a rally driven by options mechanics, the most dangerous thing you can do is assume the market will behave politely just because it should. So if the rally isn't just hype, and if the engine is really options flow, then you need to know the name of the monster you're watching on your screen. Because once you can name it, you stop panicking at the speed, and you start understanding the pattern. It's called a gamma squeeze. And I'm going to explain it in plain English, no jargon. No fluff, because if you're silver stacking or even just silver tracking day to day, this is the difference between thinking, "This is insane," and thinking, "This is mechanical." Here's the simplest way to picture it. Options have two key sensitivities that matter here: delta and gamma. Delta is how much an option behaves like the underlying asset. If an option has a delta of 0.50, it's like owning half a share, or half a contract's exposure, for hedging purposes. Gamma is the accelerator pedal. It tells you how fast that delta changes when price moves. Delta is the steering wheel. Gamma is the nitrous. Now, when silver price rises into a zone where a lot of call options are sitting, big, crowded strike prices, delta doesn't change gently. It can change fast. That's the trap for dealers and market makers who sold those calls. Because when the calls move closer to being in the money, the dealer's risk grows rapidly. And dealers don't get to feel optimistic or feel bearish about it. They have risk limits. They have models. They have a job. Hedge the exposure. So what do? They buy futures or underlying exposure to neutralize the risk. That buying isn't a choice. It's a requirement. It's what you could call a forced bid. Buying pressure that exists even if the dealer hates the rally and would prefer price to drop. And here's where it gets wild, as they buy to hedge. The buying pushes price higher. Higher price increases deltas. Higher deltas mean they need even more hedging. More hedging means more buying. That's the loop. That's the squeeze. The market isn't climbing step by step like a normal uptrend. It's being pulled upward by a demand curve that gets stronger as price rises. That's why these moves feel unnatural. You've seen it. A sudden vertical push that looks like a rocket candle. Then a shallow pullback that barely breathes. Then a dip that gets reclaimed instantly, like the market refuses to stay down. And then the close comes in hot, near the highs, because the hedging pressure doesn't politely shut off. In a gamma squeeze, the closer you get to the crowded strikes, the more intense the hedging becomes. It's non-linear. A small move can flip into a big move faster than most traders can react. This is exactly why old habits get people hurt. In a normal range, resistance is where rallies stall. In a squeeze, resistance can become a magnet, because price is being dragged toward the very strikes that create the hedging demand. That's why silver tracking matters here, not to obsess over every tick, but to recognize the signature when it appears. Acceleration near key levels, snapback dips, and heavy momentum into closes. So don't underestimate how quickly price can travel once the squeeze starts. And don't make the classic mistake of treating it like a normal breakout that has to calm down immediately. Because when gamma is in control, the market isn't asking permission. It's executing a formula. Now, once you understand the formula, once you see how a gamma squeeze can turn hedging into forced buying, the next question becomes obvious. Why did it look so vertical on your screen? Why did silver go from climbing to teleporting? If you're silver tracking in real time, you felt it. The candles got taller. The pullbacks got thinner. And the tape started acting like it was late for something. Here's the truth. The speed wasn't random. It was the market's environment aligning perfectly with the squeeze. Think of it as environment plus fuel plus spark. The environment was thin liquidity, holidays, year-end, skeleton crews, risk managers off their desks. When liquidity is thin, price doesn't need a tidal wave to move, it just needs a shove. In normal conditions, big orders get absorbed. In thin conditions, they punch holes through the book. Every wave of buying travels farther than it should, because there simply aren't enough sellers standing there to catch it. The fuel was positioning. A lot of players were leaning the same way, short, under-allocated, or running models that assume every breakout snaps back into the range. That works, until it doesn't. And when it fails violently. Because a breakout doesn't just surprise one trader. It forces an entire crowd to adjust at the same time. That's the crowded exit effect. Imagine a theater where everyone believed the fire alarm was fake, until the smoke shows up. Suddenly, nobody is calmly walking to the door. Shorts cover to stop the bleeding. Dealers hedge because their exposure is exploding. Momentum funds pile in because their rules say, buy strength. Discretionary traders chase because they can't stand watching it run without them. Everyone is trying to change seats at once. And in markets, that means gaps, slippage, and air pockets. And the spark? The spark is timing. Breakouts near important closes, weekly, monthly, year-end, hit harder than intraday noise. Those closes are psychological anchors and systematic triggers. They influence model-based flows, portfolio rebalancing, and confirm the trend. Buyers who only act when the market proves itself at the close. So when silver breaks a watched level into a thin tape and is it near a major close, you don't just get a move, you get a re-rating. The market starts pricing a new reality. That's why your silver tracking chart looked abnormal. It wasn't just price moving, it was a whole positioning structure unwinding while liquidity was too weak to cushion it. And that's the warning. This volatility isn't a temporary glitch. Once the squeeze ignites in thin conditions, volatility becomes the operating system. So if you see sharp pullbacks, don't automatically assume the move is over. In this regime, pullbacks can be violent and still be healthy. because the same unstable setup that sent price vertical can also snap it around. The key is to recognize what you're watching, not a calm market, but a tinder dry market that finally caught fire. And here's where most people get fooled, especially if all they do is silver tracking on a chart app and calling it the truth. Because in a move like this, the chart is the headline, but the real story is the stress behind it. The paper price can scream $80. The screen can look clean, liquid, orderly, but the physical market doesn't always move in sync. And when the system is under strain, that gap becomes the signal. This is the part nobody wants to talk about, because it forces you to admit something uncomfortable. Modern precious metals can have multiple prices at the same time, depending on where you are, what form you're buying, and how fast someone can actually deliver metal. That's why paper price versus physical reality matters. In normal conditions, they're close enough that you can ignore the difference. In stressed conditions, the difference is the warning siren. Watch the pressure points, premiums, spreads, delivery timelines, location-based pricing in the major hubs. When physical metal is tight, you don't always see it first in a press release. You see it in small cracks, dealers widening their spread, premiums rising even on quiet days, inventory disappearing, lead time stretching, and sudden disparities between major markets that shouldn't exist in a perfectly functioning system. And those disparities matter because they create gravity. If one hub is paying more for real metal than another hub is quoting on a screen, metal doesn't sit still, it flows. Arbitrage pulls inventory toward the highest bid. That can amplify a move that starts in paper markets. Because as physical demand tightens supply, it becomes harder and harder for shorts to lean on price without taking real delivery risk. Shorting looks easy when you assume infinite metal. It gets dangerous when you discover the pipeline has limits. This is the strategic lens the script wants you to adopt. Stop treating spot like the full truth. Spot is a reference point. The story is in the strain around it. Price is the headline. Stress is the story. So what should you track? Not just candles. Track premiums on common retail products. Track whether spreads are widening. Track whether available suddenly turns into pre-order. Track whether certain regions are persistently pricing higher than others. Track whether the market's center of gravity is shifting, where price discovery feels like it's happening. Because in a true bull phase, the system often shows cracks first at the edges, in availability, in delivery, in the cost to source the real thing. And when those stress signals line up with what we already covered, an options-driven squeeze. A breakout into price discovery. Thin liquidity that makes moves violent. You get something powerful, confirmation from multiple layers. Not a single factor thesis. A stack of signals. That's the confidence builder. If your silver tracking shows a technical breakout, and the options flow explains the acceleration, and the physical market shows strain through widening spreads and rising premiums, the odds shift. The rally stops looking like a random spike, and starts looking like a structural squeeze with real-world backing. Because when the paper market moves first, the physical market doesn't always argue. Sometimes it follows, and sometimes it forces the paper market to catch up. Now, if you're seeing the same thing from multiple angles, your silver tracking chart breaking out, the options mechanics explaining the acceleration, and the physical market showing stress, then the obvious question becomes, what happens next? Because this is where most people lose the plot. They expect a straight line. They expect the market to reward them with calm. And the first time a red candle shows up, they assume the whole story was fake. That's the mistake. Even the strongest breakouts often retest key levels, not because the move failed, but because markets need to confirm support and reset positioning. Think of it like a new floor being installed. The market doesn't just declare it solid. It steps on it, it tests it, it tries to crack it. And if it holds, that's when the next leg becomes possible. So don't be surprised if silver comes back to the breakout zone. Don't be shocked if it tags the level that used to be resistance. In fact, in a regime shift, that retest is often the most important moment of the entire move. Because it reveals whether the breakout was a one-day headline or a structural transition. Here's the mental model you need. Surge right pointing arrow consolidation right pointing arrow retest right pointing arrow surge. That's the stair-step pattern. Explosive markets don't climb like an escalator. They climb like stairs. One hard run, then a pause to breathe. A pullback that shakes out late chasers. A test that forces weak hands to sell. Then the next launch, often faster than the first. And yes, pullbacks can be violent in squeeze conditions. That's the part nobody warns you about. In a market driven by hedging flows and thin liquidity, the same mechanics that can push price straight up can also snap it down in sharp bursts. The tape can move like a whip, but violent does not automatically mean bearish. It means unstable. It means the market is repricing in real time. So what should you actually watch if you're silver tracking this responsibly? Stop obsessing over every intraday wiggle and start watching behavior around levels. Especially on meaningful closes. Does the market hold the breakout zone into the close? Or does it lose it and stay below? When it dips, do buyers show up quickly? Or does the dip get accepted and expand? Do pullbacks get reclaimed fast? Or do they drift and bleed? That's the difference between a healthy retest and a failed breakout. Also remember what we covered about options. If positioning remains dense near major strikes, price can get magnetized and volatile as hedging flows ebb and surge. One day it feels like gravity pulls price toward a strike. The next day it feels like a slingshot. This is why predicting the next candle is a losing game here. Risk management matters more than being right on the next 5-minute move. The goal is calm inside chaos. This isn't a binary story, moon or crash. It's a process. Identify the key levels, watch for acceptance above them, expect turbulence, and respond with rules, not adrenaline. Because in a stair-step bull move, the red candles aren't the end. They're the test. And the test, if it holds, is what powers the next surge. And once you understand the stair-step path, surge, pause, retest, surge, the next lesson becomes non-negotiable. This market can reward you and destroy you in the same week. That's not drama. That's the reality of a squeeze environment. So before you hit refresh on your silver tracking app one more time, you need a security protocol for your own behavior, because the biggest risk isn't that you're wrong on direction. The biggest risk is that you get shaken out, sized out, or wiped out before the story finishes. Let's say it plainly. This is a dangerous market. Volatility is not a temporary glitch, it's the operating system until proven otherwise. The tape will whip, headlines will scream, candles will spike both ways. And if you treat every move like a personal message from the universe, you'll end up doing the two things that blow people up: chasing late and sizing big. Most investors don't fail because they pick the wrong asset. They fail because they pick the right asset with the wrong plan. They see a breakout, they feel the urgency, and they convince themselves that bigger is safer. Then the first pullback hits. Their stomach flips, and they dump the position at the worst possible moment, right before the next leg begins. That's how a bull market turns into a personal tragedy. So here's the protocol. First, define your risk before you define your reward. Know what a normal swing looks like at these price levels. In a squeeze, a move that feels massive in dollars might be routine in percentages. If a $3 drop makes you panic, your position is too big. Period. Second, avoid oversized leverage. Leverage is a tool in calm markets. In squeeze markets, it's a trap, because the market doesn't move politely. It gaps, it slips, it punishes tight stops, and if you're over-levered, one ugly candle can force you out even if you were right. Third, separate your roles. Keep your long-term conviction holdings separate from your short-term trades. That way a temporary shakeout doesn't trick you into liquidating your core position. If you're stacking as a strategy, treat that stack like a foundation. Don't let a 5-minute chart bully you into selling it. Use your trading account for tactics, not for your entire thesis. Fourth, plan entries and exits like a professional. Use staged buying or position sizing. If you want exposure, build it in steps. That turns volatility from a threat into an advantage. When dips come, you're not panicking, you're executing. And finally, control your silver tracking. Don't let it control you. Watching every tick is how you convert volatility into anxiety. Use alerts, track closes, track behavior around levels, then step back. Your edge isn't speed, your edge is discipline. That's the whole point of the security protocol. It turns excitement into structure. Because yes, opportunity is real. But in a squeeze, the market moves faster than emotions can keep up. Your plan has to be stronger than your feelings, or you won't survive long enough to be right. And once you've got your security protocol, once you're thinking in rules instead of adrenaline, now you're ready to zoom out and see the real point of the story. Because this isn't just about surviving the next pullback. This is about recognizing that we may be entering a phase where the old tops stop mattering. Here's the hook that most people miss while they're silver tracking every 5-minute candle. $80 isn't a finish line. It's a doorway. It's the kind of psychological barrier that, once cleared and held, can change the entire map. Markets don't just break major levels and then politely return to the old range like nothing happened. When a multi-year ceiling fails, price discovery can accelerate. The market can reprice to levels that sounded ridiculous just weeks ago, not because the world magically changed overnight, but because the market finally admitted what was already building underneath: scarcity pressure, industrial demand, and financial flow alignment. This is the bigger thesis. The squeeze is the spark, but the fire can keep spreading. Think about what we've stacked so far: a confirmed breakout, options-driven mechanics that can force buying, thin liquidity that amplifies momentum, and physical market stress signals that can tighten the screws on paper shorts. When those layers line up, the rally becomes more than a trade. It becomes a systemic re-rating. And that's when the language changes from "nice move" to "historic moment." From temporary spike to paradigm shift. From profit opportunity to wealth transfer. Not because we're chasing hype, but because that's what happens when a market exits suppression and enters expansion. But don't misunderstand me. Expansion does not mean a straight line. A multi-stage upside move usually comes in chapters. You get the breakout, then you get consolidation, then you get renewed squeezes as positioning reloads. Then you get shakeouts designed to punish late chasers and scare out weak hands. Then you get the next leg, often faster and higher than the last. That's how trends build. That's how markets staircase into new ranges. And if you expect a smooth ride, you'll confuse normal turbulence for failure. This is where conviction with adaptability matters. Hold a core view, if the mechanics and the real-world stress signals keep validating, but stay mentally prepared for the market to test you. Because in an expansion phase, the biggest mistake isn't buying too high. The biggest mistake is selling too early because you couldn't handle volatility that was actually part of the process. That's the persuasion peak for a reason. It's fighting the most common emotional reflex: it's too late. The crowd always says it's too late right before the next stage begins. Because they're anchored to the old range. They're still measuring today's price against yesterday's ceiling. But if this is structural, yesterday's ceiling is irrelevant. It becomes the floor, the reference point, the launch pad. So keep silver tracking, yes, but track the right things. Track acceptance above key levels. Track whether dips get bought. Track whether the physical market stays tight. Track whether options positioning continues to create magnets and accelerants. Because if those signals stay aligned, $80 won't be remembered as the top. It will be remembered as the start. And if you take nothing else from this entire breakdown, if you forget the metaphors, the drama, the headlines, remember this: fast markets punish the unprepared and reward the structured. That's the final lesson of a squeeze environment. The opportunity is real, but the margin for confusion is zero. So now we funnel everything into action: simple, practical, and repeatable. First, stay plugged in, but not plugged into noise. If you're silver tracking, don't doom scroll hot takes. Don't let random accounts and recycled narratives hijack your plan. Your edge doesn't come from having more opinions. Your edge comes from tracking the right signals with discipline. Here's your checklist. Keep it tight. 1. Key levels on meaningful closes. Intraday spikes can lie. Closes are receipts. Is silver holding above the breakout zone into the daily and weekly close? Is the market accepting higher prices? Or rejecting them? If it holds, the floor is forming. If it fails repeatedly, the market is telling you to be cautious. Track closes, not emotions. 2. Options flow and positioning.